Imagine two college friends, both 31, starting careers simultaneously. One Tuesday, each invests $10,000 into a 401k, opting for the same total stock market index fund. They both never touch it again for 35 years. Despite identical funds, markets, and discipline, one friend, let's call him Michael, ends up with $75,000. You, however, finish with only $14,000. A staggering $29,000 is effectively missing from your account. You didn't make bad investments or sell in a panic, you did nothing wrong. The crucial difference was your employer's size. You joined a company of 41, while Michael worked at one with 30,000. No one told you this was a critical financial decision. This disparity is not an error, it's an inherent design feature of the system. Yank uncovers these financial layers so you don't have to read dense fee documents. If you felt like you're running uphill despite doing everything right financially, it's because the system quietly decides how much of the market's return you get to keep. Michael, in a large hospital system with 30,000 employees, has a better deal for the same index fund. You, at a dental supply company with 41 coworkers, received a basic benefits folder. Most investment advice focuses on fund choice, but ignores the system around it, including your employer's chosen 401k plan. You don't select your 401k, your employer chose an administrator long before your hire. This choice impacts every dollar saved for decades. The 401k averages book reports that a small plan, $5 million, pays about 1.1% annually in total costs. A $50 million plan pays about 0.8%, but a very large plan with a robust low-cost index menu pays under 0.1%. Different price tags for the same funds often arise simply due to the number of employees splitting administrative costs. At Michael's company, thousands share the cost of record keepers, auditors, and advisors. At yours, only 41 do. A 1% fee might seem minor, but it's deceptively expensive in personal finance. For example, consistently saving $6,000 annually for 35 years at 7% gross return, Michael's plan would yield $815,000. Your plan would result in $656,000, a $159,000 difference for the exact same fund and market conditions. This sum could buy a house in much of the country. To be fair, fees have significantly decreased. The average expense ratio fell to about 0.3% in 2024 from over 0.8% in 2005, saving investors nearly $6 billion annually. This fee war was a win for consumers. However, if funds are no longer generating substantial profits from direct fees, a different question emerges: how do free trading apps remain highly profitable businesses? The fee didn't vanish, it simply transformed its appearance. Consider the trading process itself. When you use a commission-free app to buy, your order often bypasses traditional stock exchanges. Instead, it's sold to a wholesale market maker who pays your broker for the right to fulfill it internally. This is called payment for order flow. According to the Congressional Research Service, the 12 largest U.S. brokerages collected approximately $3.88 billion from this practice in 2021, with Robinhood alone earning around $974 million. While Robinhood disclosed earning a tiny 0.002 cents per share, these small amounts accumulate to billions when executed hundreds of millions of times, often for users who believe the service is completely free. Although competition among market makers can lead to price improvement for some orders, the SEC still fined Robinhood $65 million in 2020 for cases where price differences reached up to $15 per order, highlighting potential issues with this system. Furthermore, your uninvested cash also works against you. Michael, for instance, has had about $4,000 sitting idle in his account since March. This cash is actively generating returns, just not for Michael. Any uninvested funds are typically swept into a partner bank, which then earns interest on those deposits. While you might receive a tiny fraction of this interest, the bank benefits significantly. In 2024 and 2025, several class action lawsuits were filed against major financial institutions like Schwab, Morgan Stanley, LPL, Ameriprise, and Merrill regarding this exact practice. One complaint alleged Morgan Stanley earned roughly $8 billion in a single year from swept customer cash, while some customers received as little as 0.01% interest. Schwab, similarly, paid under 0.5% when the federal funds rate exceeded 5%. This reveals that you might perceive yourself as an investor, but in these scenarios, you're functioning more as a depositor. Intriguingly, in 2024, Robinhood generated about $1.1 billion in net interest income, surpassing its earnings from trading. This means the trading app's primary revenue source is not trading, but rather your uninvested money. The claim of free is accurate, but it never specified for whose benefit. You might think that if you minimize cash and only invest in a broad index fund until retirement, you'll be fine, and that truly is the optimal strategy. However, the index itself hasn't remained static. By the end of 2025, the 10 largest companies within the S&P 500 are projected to constitute roughly 41% of the entire index, with some 2026 estimates putting it above 43%. For perspective, at the peak of the dot-com bubble, when the market was considered highly irrational, this figure was below 27%. In 1990, it stood at approximately 19%. This means that when you invest in a fund tracking 500 companies, nearly 40 cents of every dollar is allocated to just about 10 of them, with companies like Nvidia representing around 7%, Apple slightly less, and Alphabet just below that. Asset Management estimates that the index's effective number of holdings has fallen to less than 10% of its actual count, marking a 15-year low. You own 500 companies in the same way a fruit salad with only one strawberry contains strawberries. Even Michael's low-cost plan won't solve this. Cheap access to a concentrated index is still a concentrated index, just at a discount. While skepticism about bubble talk is warranted, it's important to note that these 10 dominant companies now generate approximately one-third of the index's total earnings, a significant rise from roughly one-sixth in 2015. This isn't irrational exuberance, it's market value reflecting genuine profit. However, the valuation has shifted. The Shiller-Cape ratio, which smooths earnings over 10 years, is currently around 40, whereas the long-term average typically ranges between 17 and 32. Historically, entering the market at such high Cape levels has been followed by lower 10-year returns. Yet, anyone who exited the market based on Cape since 2014 has missed substantial gains, spending a decade in cash. So, while you followed advice to buy the whole market, the market itself silently became a bet on a handful of highly valued companies. Beyond the arithmetic, a fundamental number shapes the entire financial landscape. The Federal Reserve tracks who truly owns American corporate equity. As of late 2025, the top 1% of U.S. households possess 50.2% of all corporate equities and mutual fund shares. To reiterate, a mere 1% of households own half of the stock market. The top 10% collectively own approximately 87%, while the bottom half of the country owns only about 1%. This isn't a widespread moral failing, it represents a distinct ownership structure that has evolved recently. In 1975, private sector pensions had 27 million active participants, with 401k-style plans accounting for 11 million. By 2023, these numbers had drastically flipped, only 11 million remained in pensions, while 96 million were in 401ks. Within a single working lifetime, we shifted the responsibility for market risk, longevity risk, and portfolio management, tasks previously handled by institutions with professional actuaries, onto individual investors. You weren't trained or compensated for this new role, it was simply added to your responsibilities alongside benefits and parking, with a wish of good luck. The impact of this shift isn't dramatic financial ruin for most, but rather a subtle erosion of security. It looks like being 61, calculating your retirement date, seeing it needs to be 65, then quietly changing it to 67, just to improve the numbers. The median 401k balance in the US is $44,000, not the average. At a 4% withdrawal rate, this provides only $147 a month, insufficient for rent in most places. It also manifests as colleagues accepting early retirement packages, and individuals making hardship withdrawals, tripling since the pandemic, fully aware of the costs but with no better alternative. Now, let's introduce David, also 31, who operates under the same market conditions and uses a broad index fund. What differs for him is what he is legally allowed to invest in. In 1982, the SEC defined an accredited investor as someone with $200,000 in income, $300,000 jointly, or a $1 million net worth, excluding their primary residence. Meeting these criteria grants access to private company investments, falling short means you are protected from them. Crucially, these financial thresholds have never been adjusted for inflation in over 40 years. In 1983, less than 2% of U.S. households qualified. By 2022, that number had grown to 18.5%, or 24 million households. The barrier didn't open, inflation simply eroded its effectiveness, allowing David to pass through. This means David gets allocations in pre-IPO companies, which is more significant now than ever due to where wealth creation truly occurs. Jay Ritter at the University of Florida, who tracked American IPOs since 1980, found that the median company age at listing in the 1980s was 8 years, now it's 12 to 13. Companies experience their most explosive growth phase while still private. By the time you, the average investor, are legally permitted to buy shares, much of the promised growth has already happened in exclusive circles. Neither you nor Michael, with his low-cost plan, are typically in these rooms. His plan only offers a slightly better position in the same waiting area. When a company eventually goes public, the average first-day pop since 1980 has been approximately 19%. This immediate gain benefits those who secured an allocation at the initial offer price. If you buy at market open, you're purchasing after this jump, missing out on a cumulative total of around $250 billion, according to Ritter's estimates. Then there's the tax advantage. If you sell an asset with $70,000 in gains, you'd pay around $14,000 to the IRS at the long-term capital gains rate. David, however, often doesn't sell. Instead, he borrows against his identical position using a securities-backed line of credit. At roughly 6.5% interest, this might cost him about $9,000 over 2 years, but he retains the entire asset and all future appreciation. The catch is that these credit lines usually require around $500,000 in pledged collateral to qualify. David ends up paying less than your tax bill and keeps the asset. Upon his death, his heirs receive a stepped-up cost basis, meaning the gain is never taxed at all. This strategy is known in tax circles as buy, borrow, die, a considerably more profitable approach than paying taxes. You and Michael argued over basis points, while David operated under an entirely different tax code. The disparity among the three of you isn't about intelligence, discipline, or risk tolerance, it's about a 1982 rule dictating who is deemed sophisticated enough to manage their own money. You might counter that retail investors underperform due to poor behavioral choices, and some data supports this idea. Morningstar reported that the average dollar invested in a fund earned about 7% annually, while the funds themselves returned 8.2%, suggesting a 1.2% gap, worth roughly 15% of total returns. However, a 2024 academic paper re-examined Morningstar's own sample and found that the actual cost of mistiming the market was closer to 0.1% per year, not 1.2%. Much of that perceived gap is simply the natural effect of consistently contributing into a rising market. Morningstar itself admits the cause is debatable, so the narrative that you fall behind because of individual mistakes is, at best, greatly exaggerated. What is undeniably marketed to you, however, are products designed for frequent trading, like zero-day options. Zero-day options, contracts expiring the day they are purchased, now constitute approximately 60% of all SP 500 options volume, a massive increase from 10 to 20% before 2020, with retail investors making up over half of this flow. In India, where regulators publish such data, 91% of retail derivatives traders lost money in a single year, collectively dropping about $22 billion. Regulators have taken action. Massachusetts fined Robinhood $7.5 million and ordered the removal of its gamified app design, and FINRA issued a $70 million penalty, its largest ever. It's noteworthy that 38% of new brokerage accounts opened in 2020 belong to first-time investors. No one creates celebratory confetti animations for someone consistently buying one index fund each month. The latest shift is also concerning. An executive order in August 2025 directed regulators to open 401k plans to private equity, private credit, and digital assets, with the Department of Labor proposing enabling rules in March 2026. This signals the potential for high fees, illiquidity, and self-reported valuations to soon appear on your 401k menu. However, despair is not the ultimate message here. You have access to the best financial tools in history: zero commissions, index funds with expense ratios as low as 3 basis points, no account minimums, and fractional shares. Performance data unequivocally supports passive investing. SP's SPIVA scorecard for 2025 found 79% of active large-cap funds underperformed the index. Over a 15-year period, not a single one of the 22 U.S. equity fund categories saw most active managers beat their benchmark. The winning strategy is already yours. It's free, it's unexciting, and it takes about 11 minutes to set up. It is, to offer the highest compliment, the least captivating thing you will ever do with your money. This means the true challenge isn't that the financial game is unwinnable. It's that nearly every commercial entity you encounter is designed to steer you away from the single effective strategy, into options, active funds, idle cash, or private alternatives, anything that generates revenue for the person promoting it. Therefore, if you've been silently blaming yourself while watching this, stop. You're not falling behind because of a lack of discipline. You're disadvantaged by a plan you didn't choose, an app that profits from your inattention, an index that silently became concentrated, and a rulebook from 1982 that dictates your access. These 4 factors were beyond your control. As Yank emphasizes, this is educational content, not financial advice, and your personal situation is unique. Here's what Yank suggests you can do. Not all systemic layers are equally fixable. You can't instantly change the accredited investor rule or deconcentrate the SP 500, nor will David relinquish his pre-IPO allocations. However, you absolutely can discover the precise costs of your 401k plan. This information is detailed in a document called the 404(a)(5) fee disclosure, readily available from your HR department, a document rarely requested. Additionally, you can ascertain what your broker pays on your idle cash and, if the amount is insultingly low, move those funds elsewhere. These 2 simple inquiries, Yank argues, could potentially generate more wealth than all your stock picks this decade. This isn't just motivational, it's the $159,000 difference translated into a practical to-do list. The core question to carry forward, applicable to any financial product for the rest of your life, is this: who truly benefits when I make this choice, and would they still benefit if I simply opted for the straightforward, unexciting alternative? Every insight you've gained is derived from this single question.